that, we'll be actually covering some of the computing the loan forgiveness. And also we'll be covering, and there's more guidance to be issued, what information we need to supply with the loan application so the banks can actually audit this and review this and so forth. The other thing that it's interesting is that came out just on Friday is the SBA was talking about how it's going to be reviewing the PPP applications, and we'll be talking about that. And then at the end, it's probably some of the most important topics to talk about is what strategies we can do to maximize your forgiveness. And it's not a one shoe fit all type of thing. There's a lot of different technical things. Each business, each industries are facing different challenges in the economy. So these are all important things. Also, there's the PPP program has effects on other tax provisions. One provision is the deferral of the employer share of the FICA tax through the end of the year. If you haven't done it, you're able to defer the employer share of the FICA tax through December 31st of this year. Once you get the letter from the bank saying there's loan forgiveness, you have to stop that and then continue paying the FICA taxes of it. And then the other one is if you get PPP money, and there was a May 28th date, April date that we passed, April 14th date that passed, that basically says if you returned your PPP money, then you can get the employer retention credit. But right now that time frame has passed. So if you have the PPP money, you're no longer able to claim the employee retention credit. Next slide. Okay, so one of the other big provisions of the CARES Act in the PPP is if any amount of the loan is forgiven. So if you had a $200,000 loan and you end up spending it where $150,000 of that loan, PPP loan, is forgiven, and it's not technically forgiven, you don't have to, the company doesn't have to pay it back, the SBA pays the bank back. If you have $150,000 of that loan forgiven, then it's not subject to federal income taxes, which is a little thing. Now, it's interesting to point out that the IRS recently ruled that the expenses that were relating to the debt forgiveness is not deductible, and Congress is disagreeing with that conclusion. It was not the intent of it, but they never explicitly said that. So there may be some new rules coming out of Congress dealing with this, and maybe allowing the income tax deduction. Now, what we're going to be talking about, in order to have it forgiveness, it's going to be eligible costs during the applicable 8-week period, okay? And during that 8-week period, if you can imagine a cap, okay, so what you can have is 75% or more in payroll costs. And non-payroll costs, you can't have more than 25% in that bucket. People had thought that there would be cliff costs, meaning if you spend 33% in non-payroll costs like rent, then you would lose all the forgiven part. That's not the case. It will be capped at 25%. Now, as I said before, the eligible cost is payroll costs, which includes retirement and health insurance. It includes interest on mortgage obligations incurred before, and this is for obligations incurred before February 15, 2020. So any debt, the debt had to be in existence. And this is on real and personal property, and we'll go into that a little bit more. Also, we'll have rent expenses on leases enforced before February 15. And it'll cover certain utility payments for which it's enforced for February 15th, 2020. Okay. Now, Congress is also talking about possibly changing that May 8th date, the 8-week period, to a 12-week period. Next slide. Okay. Now, we'll go into it a little bit further, but the costs must be paid, incurred during that covered period, and we'll talk about that. It's not really accrual basis accounting. It's not really cash basis accounting. When Congress talked about this and what the SBA interpreted it, it's a little bit like a quasi-accrual versus cash, and we'll go over that. The other thing that's interesting is that owner's compensation look back. So the look back basically says you can't pay the owner and have it forgiven. You have to look back to the 2009 compensation. And an owner is defined as an owner employee of a sub S, C Corp, self-employed individuals, partners, or general partners. And then there's another concept, because the payroll processing doesn't necessarily coincide with the 8-week period with the date of when the covered period starts, which by the way starts the day you receive the PPP money. So if your payroll started if you paid your payroll the day before you receive funding of the PPP money, you may not actually be able to get 8 weeks in there. And we'll talk about it later, but there's actually an alternative payroll covered period that may get you a little bit more of your 8-week period in line with when you actually pay your payroll, as opposed to changing your payroll process. And then the other piece is a full-time equivalent is an employee with more than 40 hours. Next slide. Next slide. Okay, so this is the key, one of the key lead pages of the form. Okay, this just came out just last week, and all businesses who wish to apply for the PPP forgiveness will have to complete this. It isn't an income tax return, but it's just like filling out a personal income tax or business income tax return. It's very technical. Some of the questions look easy, and there's some traps in here that we'll try to point out as we go through it. So the key things on this is halfway in the middle of the page, it says employees at the time of the loan application and employees at time of forgiveness application. That was previously never needed or was requested or asked, and we don't know how that all plays into the application process or the forgiveness application. Maybe it's up to subject future guidance that they may issue, but that's information that we need to do. The other questions are that on it that needs to be answered is your payroll schedule, weekly, bi-weekly, twice a week, monthly, or other. And then the other one is the covered period. The covered period starts the date the funding begins, and then it goes an 8-week period. Now, what's really interesting is the last box on the bottom, which is the midway down the page. It says if a borrower, together with affiliates, if applicable, receive PPP loans in excess of $2 million, check here. Now, there was a comment that was verbally made by the Secretary of Treasury, who indicated that all loans will be reviewed by the SBA, and we'll go into that in more than $2 million. The recent guidance that came out after that indicated that it may or may not, they may or may not look at other ones. Next slide. The next slide is the bottom half of the page, which basically gets into some of the technical issues and the accounting issues and number issue. Line 1 is dealing with payroll costs, and we'll get into that in great detail. The second line is mortgage interest, rents, utilities, and so forth. And then once you get to that total, then we'll get into the details. These are where you can actually lose debt forgiveness or PPP forgiveness. There's a salary hourly wage reduction, and then there's a full-time equivalent reduction. And there's some safe harbors there. Now this is important. Then when you get to the total, then you get the PPP loan amount. And then you multiply the payroll by the 75% to get to that cap. And line 11 is the debt forgiveness. We'll get into that detail, but the important thing is this is very critical time to start reviewing it now. We'll get into it later on. As you know, a lot of companies are in week 6, 7, or 8, and so they should be planning accordingly. And now we're going to go into a little bit more detail. I'm going to turn this off to Joe Tancer. Thank you.
Thank you, Barry, for that excellent introduction to the subject. Good morning, everyone. I'm Joe Tancer, a partner in Janover. So I'm going to take you now through some other sections that apply to this application, which, as Barry mentioned, just came out a little more than a week ago, and sort of helped to clarify some of the questions that we had, but created some other questions. And as we go through this, you'll probably get to see exactly what I'm talking about. So on this slide that you're seeing in front of you, this relates to Schedule A. Schedule A are where we have entries that eventually feed into that first page that Barry covered. So this is sort of like the first backup. And as you can see, even looking at the first few lines, the entries from here come from worksheets. And so the worksheets are yet another backup, a backup to this, and it flows this way. And just helping to indicate and reinforce the fact that a lot of this stuff is complicated. So in this top section, the first 3 lines, we call this the salary reduction computation, which you'll see. It shows that there's information coming from another worksheet, which we're going to show. And it has the FTEs, which the full-time equivalents, and shows the salary reduction, again, coming off that worksheet. On the second part of that page, table 2, again, we're looking at compensation from a different worksheet, which we'll take a look at as well. And you'll see that the average FTE is here, but there's no computation of the FTE worksheet reduction. And that is because that's done in total, as opposed to what you're going to see that the worksheets are in detail. And so let's move to that slide now, please. So this is where you list information. So there are some things that, just are very obvious when you look at this. One is that you're going to have to list all of your employees, right down the line, no matter how many you have. Obviously, if you need more pages, you'll use more pages. But you have to list your employees. The next section asks for an employee identifier. The government has told us that that's the last 4 digits of the Social Security number. Then cash compensation, which includes a lot of things that Barry mentioned before. Average FTEs for each person, and that's computed based on a 40-hour full-time equivalence. And then finally, on the table 1, you notice there's another column which doesn't appear in table 2. And so let's distinguish these 2 tables, and then we're going to see exactly why. So in both cases, oh, no, return, please. So in both cases, we're including employees who we're going to show information for the covered period or the alternative payroll covered period. So let's discuss now the covered period. You know already is the period that begins with the date you receive the money. The alternative payroll covered period, which I like to call the APCP, applies at the start of the first payroll in period that takes place after the receipt of the money. And you can only use that if your payroll frequency is biweekly or more frequent. So really it's biweekly or weekly payrolls. Those who will pay semi-monthly or monthly cannot use that APCP. And it only applies to employees who were employed during this period. So we're not listing anybody who was not employed during the period, which is a good thing, and I'll tell you why in a minute. But it also applies to people who are residents of the United States. So anybody who is employed, even for a US company outside the United States, would not be on the schedule. And the reason why this is a good thing, that we're only looking at people in the covered period, one of the questions that we had very debated and discussed with many of our clients is as to whether or not people who got laid off prior to the covered period would be subject to the salary reduction. Well, this shows us, because the salary reduction is computed here on this schedule, and we're only putting on people who were employed during the covered period or the APCP, that it only applies to those people who were actually working during this period. So if somebody got laid off beforehand, they're not subject to salary reduction. And that's a very good thing. The second table applies to people in this covered period also, but the distinction is the second dot. So on the top table, table 1, these are for people who made at a salary at a rate of less than $100,000 per year at all pay periods throughout the year. So in other words, saying never more than $100,000 a year on an annual basis. In table 2, we're talking about employees who at some point, any point during 2019, made at least $100,000 per pay period on an annualized basis. So it's any pay period where more than $100,000 on an annualized rate goes into Table 2. One interesting factor before we move on is that these tables do not include the owners. Owners are completely eliminated from here. So owners are not subject to salary reduction, and owners are not subject to the FTE reduction, because all of that information feeds from these tables. Okay, next slide, please. Okay, so a little greater look at this schedule, Table 1. We've pretty much covered it here and what I was just talking about, but I wanted you to see it this way by itself so that you're not distracted in any way. You're asking for information. This is only about employees. This is only for people who, at all times throughout the year, were paid at a rate that is less than $100,000 per annum, okay, or 100 or less, actually. And this was all times during 2019. So 19 is the key period. If the people didn't work in 2019, they belong on this schedule also. So, so even a person who presently makes more than $100,000 a year, but didn't start, let's say, to 2020, would go on this schedule because that person didn't work and get paid more than $100,000 a year at any time during 2019. All right, next slide, please. So this schedule, of course, does not have salary reduction. And the reason is that anybody who makes more than $100,000 a year or made more than $100,000 a year at any time in 2019 is not subject to the salary reduction. Again, this is not the owners. This is just the employees. All right, you can move to the, actually, Barry, you can take the next slide.
Highlights of these detailed schedules. Now, when you look at the definition of cash compensation, we got a little bit more color on it as of last Friday, because we always were curious whether cash compensation, what's the true definition of it? Was it gross or net or how it was be? But they also included gross payroll, bonus, including gross payroll, they included bonuses and also hazard pay in there as well. So gross compensation means just what it means, gross compensation. It includes tips and it includes an allowance for dismissal or separations. What's interesting in there, it talks about paid or accrued. And we get into this concept of what happens. So it's interesting in that when it talks about payroll costs paid or accrued or incurred, this includes payroll costs paid by dates that's distributed through your ACH credit. So if you do a wire transfer or pay by direct deposit, it's the time you initiate the ACH as opposed to necessarily hit the banking accounts. It also includes costs incurred during the covered period on that pay date. And it also includes payroll costs not paid by the end of the covered period, but it also includes payroll in the next payroll period. So if your payroll ends on, let's say, June 25th, or your covered period ends June 25th, and you paid people on June 26th, then, and that's your next regular payroll period, then it's included, so companies don't have to modify that. Now, what's also included is the maximum cap that is eligible for forgiveness is $100,000 of annual salary for those folks. Now, if you take 8/12 of that, that equals $15,385. So the maximum compensation that you can include in there for Table 1 and 2 is the $15,385. It doesn't include any compensation paid to any employees whose principal place of residence is outside the United States, and you have to make an adjustment for any qualified leave or family leave wages where you take a credit on it. Let's go into, and then also, it also includes even though we'll eventually get into the health insurance piece and the retirement pay, but let's continue to the next slide. Okay, now the next thing is, and this is probably the most overlooked piece of the debt forgiveness calculation. We'll get into a little bit of the highlights a little bit more, but one of the things that everybody needs to manage is their full-time equivalent average, okay? And basically, each company has to evaluate each employee on a payroll per day, your full-time equivalents during the covered period or the alternative payroll covered period, which we'll get into it. For each employee, what you have to do is figure out the number of hours that they worked each week, divided by 40. If somebody worked more than 40 hours, then it's going to be capped at 1. If somebody is full-time, they're going to be counted as 1. If somebody worked 20 hours during the week because they're an hourly person, then they're going to be given a half. If they work 30 hours, they're going to be given 3/4 of an hour, 3/4 of a full-time equivalent. And here's just a quick example. So if on one payroll period, you have an employee that works 40, that's one full-time equivalent. Yet another employee worked 20 hours, that's a half full-time equivalent. And then you had another full-time person working 40 hours, it's a 1.0. And another person, the fourth employee, worked 20 hours, that's 0.5. Those 4 people, the total full-time equivalent is 3. For that week, it's given a 3. And that's important because you're going to have to monitor that on each payroll cycle for the covered period or the alternative cover date. And then there's a simplified method. And the simplified method says if you had somebody working 30 hours or you had somebody working 10 hours, instead of tracking like 0.2, 0.3, 0.5, 0.1 of a full-time equivalent, the SBA issued a simplified method full-time equivalent average. And what they said is if anybody works more than 40 or more hours in a week, that's one full-time equivalent, 1.0. And if somebody worked fewer than 40 hours, then you're given a half full-time equivalent. So if you have a lot of employees working 5, 7, 10 hours during that week, instead of start calculating the tenths, you can just round up to 0.5. Now that's the election used by, that's an election used by the borrower. And whatever method you use, the simplified method or the regular, then you have to use it for all of your calculations, whether it be the covered period, the APCP period, or the look back periods in 2019. Those are very, very important things. And we'll get into why this is important shortly, but we'll talk now. I turn it over to Joe talking about the hourly wage reduction. Next slide.
Thank you, Barry. So there are 2 possible reductions that affect your overall forgiveness. One of them is called the salary hourly wage reduction, which is what I'm going to cover now. And then there's the FTE reduction, which Barry will cover in detail later. And so it turns out that the application of these 2 reductions are done differently. And so with the salary reduction, salary hourly wage reduction, we have to go person by person, determining the reduction for each person. When it gets to the FTE reduction, you're going to see that although you calculate the FTE for each person, but the reduction itself is calculated based upon the total amount of reduction as compared to the look-back periods. So let's go through here. On the salary hourly wage reduction, again, I want to remind everybody that this applies only to employees who worked during the covered period and who made less than $100,000 at all times during 2019. And the salary reduction is based upon the covered period wages that you pay, the rate at which you pay, either the salary or the hourly wage rate. compared to 75% or a reduction of 25% from the rate at which they were paid in the first quarter of 2020. So as an example, if somebody was paid at a rate of $1,000 per week in 2020, and if the person was paid at least $750 a week during the covered period, there would be no reduction in the simplest form. If the person made, let's say, $600 a week, there would be a reduction, the difference between the $750 and the $600 or $150 per week. And then it goes into a computation of how you figure out how much that reduction is. And I think the best way to explain that is in the form of an example, which we will get to in a couple of slides. Next slide, please. So you're entitled to a safe harbor election or calculation if certain conditions are met. So as I just pointed out, there's a potential salary reduction if there is a reduction in the covered period wages or salary as compared to the first quarter of 2020. However, if you do have that reduction and you pass another couple of tests, you might be able to get that reduction eliminated. And that's what we call the safe harbor. So we need to now shift a little bit. Instead of looking at the first quarter for this safe harbor, we look instead at the February 15th to April 26th period. So that's a little bit more than 2 months. We're going to look at the average annual salary or the hourly rate between those periods and compare them to what was in effect on February 15th, 2020. If there is a reduction there as well, and you bring the average annual pay, whether it's salary or hourly rate, back to where it was on February 15th by June 30th, sometime before June 30th, as long as you bring it there to either greater than or equal to that rate of February 15th, then the safe harbor applies. And if the safe harbor applies, then that salary or hourly wage reduction that you computed in the first step, which is the covered period versus the first quarter, is eliminated for that employee. And that's, this is Congress's way of saying, listen, we know that during the covered period, you might have had a hard time getting people paid, but as long as you bring them back at the end of the period, which is, or June 30th, then you can then eliminate that reduction. I think what happened here is that Congress thought this was going to last till maybe June. We now know that this COVID effect could affect the economy much greater period than June. But I think the original intent was to set a date that was based upon when this law was passed, which was at the end of March. People were talking about this going for a few months. So I think that was the intent here. But the provision stands at June 30th unless anybody comes along and changes it. And as Barry mentioned, there is legislation to make certain changes. This June 30th date, though, is not being discussed. So at this point, we're going to stay with June 30th. Okay, next slide, please. So this is the start of the example that I want to go through with you to understand the salary hourly wage reduction. So we're going to go through this step by step, and this is going to show us how the reduction is initially calculated in step 1, in step 2, whether or not the safe harbor applies, and step 3, if in case the safe harbor does not apply to a particular employee, how do you calculate the reduction? Okay, so that's where we're going with this. All right, so we have here 7 employees. Just for sake of simplicity, we call them A through G. Obviously, A through E are full-time salaried people. F and G are hourly wage people. F is a half-time worker, figure 20 hours, and G is a full-time worker at 40 hours. So the first column looks at the maximum rate in 2019. The reason for that column, obviously, if somebody made more than $100,000 at any time during 2019, there is no reduction. So clearly C stands out, and we should see no reduction for C, no matter what happened afterwards. The average of the first quarter is shown in the next column. As you can see, for certain employees, the rate stayed the same as 2019, and others experience a change. The payroll of February 15th, which is a key point in looking at the safe harbor, that salary is set. In many cases, it's the same. Obviously, in case of D, that salary went down already by February 15th. So at that point, maybe the employer said, wait a second, I've got to start doing something because I see this COVID coming and I got to reduce salary. Then there's an average from February 15th to April 26th. That's that two-month plus period that I mentioned. That's when people really started to see reductions in salary. Employee D was able to retain the rate that was set at February 15th. So that employee did not suffer a further reduction. And then in the next column, we have the covered period or the APCP. It really doesn't make a difference for the purpose of this computation. This is the 8-week period following the loan, if it's the covered period, or it's the APCP, which is the begins on the date of payroll, the payroll period that follows the receipt of the loan and goes for 8 weeks after that point. And you can see there, in some cases, they stayed the same as it was from the beginning. Other cases from the February 15th to April 26th period stayed the same, but there were other positions where it changed. And then finally, the payroll that includes the period of June 30th, that's our safe harbor. That's where we're going to look to see whether or not we brought back our wages and our salaries. So I'm going to show the example on each of the slides that follow so you don't have to remember all these numbers. Okay, next slide, please. So again, we're going person by person. That's a very important part of this thing here. So as I mentioned at the very beginning of this example, employee C made more than 125,000 at least once in 2019. The maximum rate was 125,000 per year. So C, as you can see in the next section, which is step 1, was pay reduced by more than 25,000. Already it says does not apply. So you don't have to make a calculation beyond that point for C. And as you can see down at the bottom of that slide, no reduction for C. So what does step 1 ask? Step 1 says, let's take a look at the average annual salary or the hourly wage during the covered period or the APCP. So the covered period is the column next to the last one. And so all of those figures came into that line. And the next one is B, average annual salary or hourly wage during the first quarter, which is the second column of numbers. So what was it in the covered period? That's let's call it the 8 weeks, versus what was it at the beginning of the year, that first quarter. And when you divide them through, if you paid more than 75%, 75 or more actually, then there's no reduction. So E, column employee E, was paid at the same rate. It was 100%. So there's no reduction there either. So C and E are already out of this calculation. We don't have to go any further on those individuals. But A, B, D, F, and G, we have to continue because they were paid less than 75% of the rate at which they were paid in the first quarter. Okay, you can go on to the next slide. So now we take a look and see whether we can recover by having the safe harbor. So now we're going to look at different periods, okay? Because we already know that A, B, D, F, and G are possible reductions. We know that C and E are not. So right from the start, it says do not apply in C and E. When we get to A, B, D, F, and G, we have to take a look and see what the payroll was at the June 30th versus what it was relative to this period that we're going to look at the reduction during the period of February 15th to April 26th of 2020. And so the instructions tell us to do the following. For A, let's take a look and see where these people were at February 15th. So that column, the third column of numbers, is populated into this line, okay? So as an example, A is $90,000 at February 15th. During the period of February 15th, April 26th, there's item B in the step 2. And you can see, again, going back, just take A for a moment. During that period, his or her pay was reduced to $60,000. So obviously, we're in need of something here, okay? Because in the covered period, it was reduced to 60,000. There's a reduction, and now you can see that the employer made a change somewhere between February 15th and April 26th, lowering the pay of A down to $60,000. However, when you get to C, you can see that C's payroll was increased back up to $90,000, all the way back to where it was on February 15th. And therefore, the safe harbor applies for A. That's not the case for B, though. So when you take a look at B, and you see that B was paid on February 15th, $70,000, suffered a reduction just in the same manner that, that A had, suffered a reduction going from 70 to 45 in this case. The payroll, but for the payroll period of June, it didn't get back to the February 15th level. It only got to 60,000. There was an increase, but it had to get all the way back to 70,000 in order for the safe harbor to apply. So therefore, there is no safe harbor for B. So this is the point I want to highlight here. You need to get back all the way to the level it was at February 15th if you want to use that safe harbor. Let's take a look at D. D was paid originally at a rate of $80,000, got a reduction starting in February 15th. So therefore, there was definitely a potential reduction, especially since in the covered period, it went down even further. But from February 15th to April 26th, the salary did not go down from the February 15th level. Because there was no reduction there in that period, no safe harbor applies for D. So regardless of what happened in June, and if you take a look, June brought the payroll all the way back to $80,000. But it doesn't work because there was no reduction from February 15th to April 26th. Even though that payroll period went back to the original point of where it was at the first quarter, it has to get, there has to be a reduction during that period of February 15th to April 26th. Skipping over to F, we're now dealing with hourly people. So F and G are hourly. Both were making $20 per hour at the February 15th date, and both were scaled down between February 15th to April 26th to $14. So both of them have the potential to use the safe harbor, but in a manner similar to what one of the earlier employees had. The employer increased F's salary back to $20 an hour, which was the rate of February 15th. But for G, it only got back up to $16 an hour. So there's no safe harbor for G, and there is one for F. All right, we'll go on to the next slide, please. So from the beginning, C and E did not apply. Now A and F, both which qualified for the safe harbor, they no longer apply either for calculating the reduction itself. So let's see how we calculate the reduction. The first thing we do is we take the item from 1B, which you may recall was the amount that was being paid during the first quarter, the average annual amount. So as you can see, that number is, for B was $70,000. We're going to multiply that by 75%. And that comes to $52,500. As I mentioned at the start of this, as long as we get to 75% in that covered period, you're fine. But this one, of course, did not, and therefore there is a reduction based off the 75% figure. So what did employee B wind up with? Employee B wound up with an average rate of $45,000 during the covered period. So there's a reduction of $7,500 per year on an annual basis. So for the covered period, which is an 8-week period, we're going to multiply 7,500 times 8 and divide it by 52. And the actual reduction for B is $1,154. For D, we're going to do a very similar computation. D was making $80,000 in the first quarter. 75% of that is 60,000. Okay, and during the COVID period, D was moved to 45,000. So there's a $15,000 annual reduction for the COVID period. It's 850 seconds. It comes out to $2,308 reduction. And the hourly one is done a little bit differently. So G, it starts off the same way. You're taking the $20 rate for the first quarter and multiplying by 75%. So that's $15. And we know that in the COVID period, G was paid $14 per hour. So there's a $1 hourly wage rate reduction. So instead of doing it with the 850 seconds, the government takes this approach and says, what are the average hours that person was working during the first quarter? Well, this was a full-time person. G was at 40 hours. So now we have to multiply that $1 reduction times 40 and then multiply that by 8 weeks. And so we get up to 320. And 320 is the reduction for G. So now I'm going to turn this back over to Barry, who's going to explain the FTE reductions.
Thank you, Joe. First of all, that was a very extensive calculations, and it has to be done on an employee by employee basis. And what gets complicated is this is less than 10 employees, so you could do it on a little bit of a spreadsheet. But man, if you have 100, 200, 300 employees, this gets to be a very tedious calculations. And just to let you know that Janover developed spreadsheets, and we're tweaking them as new guidance comes out to help monitor and wage this. And there's a lot of planning on this. And just a couple of questions that came in is one person asked, or multiple people asked, when is the actual 8-week period start? The actual 8 week starts is the day you receive the funding of your PPP money. It's when the money gets deposited into your account. And another question is the other question asked is whether or not, whether these slides will be available at the end of the seminar. The answer is yes. We'll either send out notifications to those attendees, or we will post it on our website. We will let you know. But just to let you know, let's start off with this loan forgiveness computation. And let's just talk about big picture. So what you do is the following. If you get $1 million PPP loan, and let's say, for example, you spent during the covered period $750,000 in costs between payroll and non-payroll costs, okay? So $750,000, which on a high level, if you have $1 million PPP loan and $750 has been spent, okay, you know 250 you're gonna have to pay back because you didn't spend it in accordance with the plan. But this is where the reductions come in, and this is the critical piece that we're emphasizing to focus in on now. So the first thing you do is, of the $750,000 of eligible payroll costs and non-payroll costs, the first you subtract out this salary and wage reduction computation. And Joe went over that there. So if you have, let's say, $30,000 of wage reduction, then that 750 would be down to $720,000. And those are what they call adjusted eligible costs. The next piece is this full-time equivalent reduction quotient. And what that does is the purpose of it is they look at your full-time equivalent calculation during the covered period, and they divide that by the number of full-time equivalents in the base period, and we'll get into that. So if you have, let's say you have 10 employees during the covered period, and you had 20 employees during the base period, that's 1/2. So you're gonna lose 1/2 of the forgiveness of forgiveness on the adjusted eligible costs. And so there's a double reduction. One is a salary and hourly wage reduction. Then the other one, which is a full-time reduction. And that's a percentage of the total cost. And that's just not, you don't just lose it on the payroll cost. You also have to apply that reduction to the non-payroll costs. So that's why reviewing this before the covered period ends is what I feel critically important. Once you get to the total number, that's the total forgiveness amount. And on the application, that's where the application stops. But if any businesses received an EIDL grant of $10,000 or less, then you have to reduce that. So and then that leaves the balance of the PPP loan forgiveness. So that's where you go from there. Next slide. Okay, now let's calculate this full-time equivalent calculation. The first thing is again, we talked about this. We have a 40-hour work week for all full-time and part-time employees with a maximum of 1.0 for any full-time equivalent in each work week. That you could use a simplified method, and if you use a simplified method, you need to be consistently applying it on all your calculations. And the formula for the full-time equivalent reduction quotient is the average of full-time equivalents during the covered period, the 8-week period, divided by the average full-time equivalents in either of the two following periods, from February 15, 2019 to June 30th, 2019, or January 1st, 2020 through February 29, 2020. Now, what the general thing is, you're going to take the lower of it during this base period because you want your denominator lower to increase the percentage, your percentage of debt forgiveness. And if you're a seasonal employer, then they give you a flexible 12-week period to select from it. Next slide. Okay, there are safe harbors, and there's a full-time equivalent exception. Now, let's say, for example, let's say a company has 10 employees, and they reduce their employees down to 5 employees, and the other 5 employees were furloughed or laid off. And let's say now the company's opening up or back to full business or wants to bring back these people. So the borrower actually makes a good faith written offer to rehire these employees during the covered period or the alternative payroll covered period. And let's say the employee, or let's say the 5 employees that you extended an offer on, let's say one of them doesn't come back. If one of them doesn't come back, then what will happen is it will reduce your full-time equivalent. So if you had in your base period 10 employees, and let's say you have 9 full-time equivalents and one doesn't come back, you're going to get a haircut of 10% of your PPP forgiveness amount. So there's an exception to that, is if any of the employees were fired for cause, voluntarily resigns, or voluntarily requests a reduction in hours, okay? Then you can actually not have to reduce your full-time equivalent. Now, it's important that if you offer a good faith offer to an employee, and that employee rejects the offer to come back because they feel it's not safe or whatever, they are moved out of the area or for whatever reason, that would be acceptable. Now, documentation is critical. Now, it's not unusual where we have some clients already called me up and said to me, well, we offered like 5 employees to come back, 4 of them come back, but 1 of them hasn't. And they haven't even responded to our emails. We send certified letters. What in this new guidance, the SBA said that even if you don't get a formal rejection from the employee because they didn't contact you, they also say that you're supposed to report to the state unemployment board within 30 days that this person didn't do it. So that's demonstrating that. Next slide. There's another safe harbor there, and this is critically important as well, because this will get, if you had 100 employees during the base periods, and you're operating at 50% levels, okay, you're going to have 50% of your loan, not of your PPP eligible cost, not forgiven. So here's a reduction safe harbor, and it applies if you meet both conditions. One, the borrower reduced its full-time equivalence levels in the period of February 15, 2020 to April 26, 2020. So if you see a reduction of your employee full-time equivalent numbers between those dates, right? And the borrower restored its full-time equivalent levels by not later than June 30th, 2020 to the full-time equivalent employee levels in the borrower's base period that included February 15, 2020, then you're not going to have, that's a big safe harbor, and you're not going to get any reduction in it. So again, it's important to know what your February 15th date is. Now, a couple of things that's critically important is the following. If, let's say, for example, you receive your PPP money, and again, the covered period starts the date you got the payroll. So if you received your PPP funding on April 15th, and let's say 8 weeks later, it goes to May 15th, okay? During that time, all of that's eligible wages. If you restore, or let's say you brought back all your employees to the February 15th date by June 30th, any monies, any payroll that you paid subsequent to the close of the 8-week period, even though you're going to get 100% full percentage of your safe harbor reduced, just remember, any payroll paid after the close of the covered period or the alternative covered period won't be eligible for forgiveness. So it's very important of a June 30th date, but you also can restore it not later than June 30th. So if you know your 8th week is coming up, you may want to restore or bring your employee levels back up to the February 15th date to avoid to take advantage of this safe harbor reduction, as well as getting that payroll covered and your full-time employee covered and the payroll covered during that time. Now, it's also interesting to point out another thing. We don't know if Congress is going to extend this, but until Congress passes the laws, changing it from 8 weeks to 12 weeks or whatever number it does, it's not law. It's not law. It's just talk about it. So at this point in time, it's very important to manage all of this. Next slide. Okay. Now in Schedule A, we have lines. Oh, Joe, this is where I'd pass off.
That's all right. Okay, thank you, Barry. So we'll talk a little bit about the non-cash compensation piece that gets into payroll costs. So we've talked about the cash amount, which is really the gross payroll of your employees. But there are other things that you can count in the payroll costs that work towards the 75% requirement for forgiveness. So just in total, we're talking about healthcare expenses. For the most part, we're talking about employee health insurance plans when you pay the premiums, retirement contributions if you have some sort of retirement plan, money purchase, profit sharing plan, defined benefit type of plan, something like that. That counts as well. State unemployment taxes and other state employer taxes. The SUI obviously is one of the ones that affects everybody. Some others have the MCTMT in New York, and we have the ECET in New York. But these are only for employer taxes. We're not talking about taxes for the employees. It has nothing to do with the withholdings. It's only the taxes that the employer pays from the employer's funds. And the same thing is true from the retirement contributions. We're not talking about the contributions that are made by the employee. It's only the matching that the employer makes. Healthcare expenses, if you have employees contributing, we're not talking about their contributions at all. We're only talking about the amounts that come from the employer's funds. So this applies to employees, and apparently it doesn't apply to the owners though. And this is something that sort of got clarified in this process that just took place over the last week and a half. Certainly, if you file Schedule C as a sole proprietor, or if you're a partner in a partnership, benefits do not count. But it appears, based upon what we've read recently, that even owner employees cannot count the benefits. So if you're a stockholder in an S corporation or a C corporation and you are a salaried person as an officer, it appears that you cannot count the benefits there either. You can count your contributions, you can count your compensation that's made in cash to you to a certain limit, which we're going to go over. But also, it is clear now, I think, that you should not be counting your contributions that are made for these additional benefits. And it appears also that your limit is going to be based on, and actually, let's go to the next slide. I think we'll talk about it right there. So on the compensation to officers, or owners, what can we count? This is for owner employees, it's for self-employed individuals, general partners and LLCs. There's a cap, and the cap is either $15,385, which is really 8/52 of $100,000, or the 8-week equivalent of the amount of compensation that the owner made in 2019. So if the owner made, let's say $100,000 or more, then obviously it's going to be capped at $15,000, $385. If the owner made less than $100,000, then 8/52 of that number would be the lower limit. So regardless of what that person is actually taking in compensation in 2020. So this is something that came out just recently, changed a lot of our thinking. And remember, we're not putting this compensation into tables 1 or 2. So therefore, we don't have any FTE reduction. We don't have any salary or wage deduction for owners. With respect to the FTE deduction, that actually could be helpful because having them in with treating them as FTEs could actually help. But with respect to salary reduction, clearly this is a benefit by not putting them in. Okay, so I'd like to go to the next slide, please. Some of the non-payroll costs, which Barry mentioned, just to reiterate a little bit, mortgage interest payments, rent payments, utility payments, these are allowable as non-payroll costs, but they cannot exceed 25% of the overall forgiveness. So in this case, with the mortgage interest, the mortgage had to be in effect by February 15th of 2020. The rent has to be covered by a lease. It's for real property, it's for personal property, and that lease had to be enforced by February 15th of 2020. Utility payments, take a look at this list of utility payments. I think this is interesting. Electricity and gas, those are clear. Water, gas. There's one called transportation, which nobody seems to know what this is really related to as it pertains to utility, but it is listed in the Act. Telephone is allowable and internet access is allowable too. So these are good things, but they had to be in effect by February 15th of 2020. One more point on this, going back to the paid or incurred calculation. So this has to be done either paid during the covered period or incurred during the covered period and paid in the next cycle, the next billing payment. But notice I'm only saying covered period here because the APCP, the alternative period, doesn't apply to these non-payroll costs. It only applies to payroll. So, and only actually applies to payroll where it's weekly or biweekly. But certainly nothing to do with non-payroll costs. You must stay within the 8-week period that is following the loan for this section. Next slide, please. Okay, this one is, next slide, please, thank you. So what do we need to do to document payroll? Well, this is a pretty long list, actually. You're gonna need bank statements and tax filings of different kinds, state filings, even federal filings, even though we're not allowed to count federal taxes. We're only counting state taxes for our payroll costs. But still, we have to give the federal forms. We have to give payment receipts or invoices, canceled checks, statements, various, you may have to give like backup for your health insurance and retirement plans, how you calculated everything. It appears that the lenders, through the authorization of SBA, are going to want everything in order to make a calculation to see if you're doing the forgiveness correctly. One of the things we learned, you saw the spreadsheet that we just put up before in the example. As Barry mentioned, we have a very detailed spreadsheet that we use in Janover when we get information from our clients. But we're finding out that some of the payroll services, the larger payroll services, are putting together their own forgiveness calculations. The AICPA has a forgiveness calculation. There are many out there. And if they are correct, and they don't have to necessarily be done in any special way, but they can be submitted as payroll documentation, even though you know, you're not doing it yourself, and you just can hand it over. So that can probably save a lot of time and money. So Barry, I'd like to turn this back to you, to the FTE.
Thank you, Joe. In addition to that, one of the other things that the applications are requesting support for in order to get loan forgiveness is how you actually document your full-time equivalent for this application. And this is going to require you or the borrower to submit with its application the calculation of the average number of full-time equivalent employees on payroll per month employed by the borrower between February 15th, 19 or June 30th, 19, or your January 1st, 2020 through February 29th, 2020. Those are one of your base years. And if you're a seasonal employee, you're going to have to use your 12-week period between May 1st and September 15th of 19. You're going to have to be able to provide this information. Now, this is, we've been through these calculations and it's extensive. We've seen third-party payroll providers giving us these calculations. In some cases, they do these calculations, but they're not seeing the actual hours by working by employees, so they don't have that for full-time employees. Some full-time employees are just working a 20-hour work week, and they're counting them as 1 week because the rules just recently came out saying it's 40 hours. It's a full, instead of a one-time full-time equivalent, it really should be a half. So these are some things that are important, and the SBA is going to be looking at this. Next slide. The next slide, please. The next one is what you're submitting for the non-payroll documentations. You're going to have to attach copies of leases. You're supposed to be copies of notes documenting that it was in existence and enforced as of February 15th. And they're going to ask you for copies of checks, canceled checks, and verifying these payments, and also copies of invoices for these utility payments. So those are some of the things, and this is based on the instructions. I suspect that the SBA and the Treasury Department is going to come up with more guidance on it. And these have to be paid within the covered period. Now, next thing. Now, there's also a thing that says with respect to the rent, utilities, you can make payments during the covered period, and it appears that you can prepay these costs. And in addition to that, if you have a covered period starts May 1st and ends on June 25th, if you have your June 25th utility bill that comes in and it's paid, let's say in early July during that routine period, as long as it's paid within the normal course of events in the routine payroll period, I mean the utility cost period, you're going to be able to claim 1/25th from June 1st to June 25th of those costs. So that's converting it to accrual basis. You're not going to be able to claim the June 26th to the end of the month. Next slide. So so what ends up happening is once you prepare the application, now it's not the bank asking for it. You're going to have to submit it to the bank, and you're going to have to request forgiveness. And this is the application that's Form 3508. And you're going to have to be able to give all the support. Now, the bank's going to have to do the initial review, and they have 60 days after getting the complete application and all its support to determine the forgiveness. Now, as much I perceive that the bank's going to have a much more difficult time calculating this and reviewing this because they're asked to be doing some auditing work, which they may not be familiar doing. And they may be applying different rules even within the same bank. And then they're going to come up with a conclusion as to whether these loans are forgiven. And they'll send you a letter saying X number of dollars is forgiven. Now, in the guidance, it didn't indicate any way a borrower can object or protest these numbers. So once the bank makes that determination, they send it out to you, a letter saying how much they think any or all are forgiven. They can also say that none of it's forgiven. They may have come to a conclusion that you weren't even an eligible borrower, and then in that case, none of it would be eligible. Well, if that happens, then the third step is the SBA can intervene at any time. They can tell the bank that we don't want you to review it. The SBA will review it and basically audit it to determine the amount of the forgiveness. And even if you get a letter from the bank saying, let's say $1 million of your loan is forgiven, the SBA can review it up through 6 years of after the letter you get from the bank saying it's forgiven. They have the right to overrule any of the bank's conclusions. And they have 6 years to do that. So you have to keep your records for 6 years. And if you disagree with the SBA's decision, there's an appeals right that it's there. So basically, this loan forgiveness is going to be living with businesses for 6 years. So even if you, and there's going to be rules subsequent to this. So the timing of when the rules come out versus when you submit these application and the whole process, and these rules are constantly changing. So you need to monitor that. Next slide, Joe, please.
Yeah, I want to allow some time for questions, so I'm going to just try to go through the strategies here. So obviously, you need to keep very good records. As we've highlighted here, there are going to be a lot of documents that you need to furnish with this application. And so get started if you haven't started doing it. Make sure you're keeping very good records. Set up a separate bank account. We've mentioned this to a number of clients. We believe that PPP money should be segregated initially so that we can see when it comes in. We like to see how it's being spent. It's just going to make the tracking that much easier. And also we're going to be able to see how you're spending it and even use that bank account as proof of how the money was being spent in documentation. Obviously, payroll costs are key here because you want to get to that 75% level. Remember that you need to spend at least 75% on payroll costs in order to get the full forgiveness. And so that's key. FTEs, the full-time equivalents, because that's a percentage of the amount of total forgiveness, this is really important. It's actually got a greater importance than the salary reduction because that's just generally speaking. It's not for everybody, but for most people, the FTE is going to be the bigger one. So just think about it when you're considering letting somebody go or reducing someone's hours. Obviously, you have to do what's right for business, but you got to consider that too, especially as you get closer to the end of the 8-week period. Even consider rehiring employees, bringing them back, getting that safe harbor. That may be the key to avoiding some of the reductions. But it will have an effect on unemployment for those people who are collecting benefits. So, you're going to have to make a decision that may have a negative impact on the person who's collecting benefits. Because again, you have to report that within 30 days if somebody rejects your offer. So work with your advisor, whether it's your accountant or attorney or whoever is advising you during this period. Just make sure that you've got somebody there that's looking out for all these fine points that we've gone into. There's a lot of very technical stuff and probably more than most people are able to manage. As Barry mentioned, there were lots of regulations that were issued over this starts, since it's now 2 months since this thing started. We've had so many changes, and we've seen so many regulations that you really need to stay on top of it. And so it's hard to do that alone. Make sure during the covered period you retain employees. I mean, that's key. It's the most important period to watch. So if you can avoid laying people off during that period, you get the most bang for your buck. And then during that period, again, you might want to pay a bonus or hazard pay for people who are in dangerous situations. Remember that there's a $15,385 cap for the payments in total over that 8-week period.
And Joe, just a couple
Yes.
of points. I saw some questions that came up. One question is if you restore your full-time equivalents and you restore your payroll as of, let's say, June 30th, can you the following week fire or let them go back on furlough afterwards? The guidance says you just have to, the current guidance basically says you just have to restore the people as of the payroll of June 30th. It
Right.
doesn't say what to do subsequent to that. And I suspect that this is a question that's being asked across the country. And the SBA will have to come up with some more guidance on it, because it looks too easy just to hire people for the week of June 30th and then let people go after that. And again,
Right.
you can do it before that, but that remains to be seen. And
Yes, I'm
the
sorry,
other,
go ahead.
the other question is talk about prepaying. Let's say in the covered period, if you're coming up to the 8th week, can you prepay rent, and can you prepay utilities for the next 2 or 3 months? Do you have any light on that at this point?
Yeah, so there are different schools of thought on that, actually. The way that the application and a lot of the guidance that's come out before reads, it appears that you can make certain prepayments. The only exception that they've mentioned is for the interest on the mortgages. There, you're not allowed to make prepayments. But as long as you're paying in the 8-week period, it sort of satisfies what the intent of this program was, which is to get the money out there in the economy and make this economy move. So even though it may be a move or a strategy to try to maximize forgiveness, which comes out of the government's pocket eventually, it still may accomplish what the government is trying to do, or was trying initially to do, which is to get that money out there on the streets. So I think that the answer is probably still yes. We're expecting probably another 25 to 30 question and answers that's coming relating to forgiveness. And I think that maybe some of that will be clarified, but at this point, I would say it's safe to do it.
And Joe, another question that came up is about during this covered period, can you make a contribution for the 2019 pension contribution? And what about the 2020 contribution during this covered period, or even after that covered period? Do you have any insight to that?
Yes, I would say that it's very clear that you can make payments. Again, you have what was like a hybrid method. You have a window of 8 weeks in which you can make payments and have them count as long as they are qualified expenses. And so there's no distinction about which period you're paying during that period. So you can actually pay for the prior year. You can pay for the current year, make an advance as long as it stays within the allowable expenses that qualify for this.
Mm-hmm.
Yes.
Yeah, so I mean, basically, it gets this whole concept of accrual basis or cash basis. It doesn't matter what accounting methods you have. These are SBA rules, not income tax rules. So these are way the instructions and the guidance to date have been issued. And this is what we've been following, borrowing any other additional guidance that's going to come down the road. And I think that it's clear to me that there is going to be a fair amount of guidance, because there's still a lot of questions to be answered by the SBA Department. Yep.
Yep. I'm sorry, Barry. Go ahead.
Yep. So I think those are all good points. Go ahead, Joe.
I was just gonna say on that last point that as you get closer to the end of the 8 weeks, you really need to focus on how money is being spent and how much money is still available in your funds for PPP, because that's the time to strategize about which payments you're going to make. You should be doing it all along, but certainly as you get closer, when you get to the 7th week, certainly, and obviously the 8th week, you're going to have to make decisions about how you want to spend the rest of this money. And that's when you may say, okay, what creative ways can I do this? Can I prepay certain expenses? Can I look back and pay for a prior period? And, as long as the answers are yes, and they remain yes, you'll have that opportunity to do it. But also, as we've mentioned, during that last couple of weeks, we may get other pronouncements that tell us there's some sort of prohibition on that. So we're gonna have to watch it all together very carefully. That's why you have to work with your advisor and make sure that you're staying on top of the process.
And Joe, that's a great point. And besides that, some of the key things is with these FTEs, and if your full-time equivalent employees are lower than the base period, you may make some, I'll call it non-business decisions to bring people back, try to get that full-time equivalent calculation back up to 100%. And it may not necessarily make business sense to do that. So you're making some decisions that you may bring back employees to maximize your forgiveness. So there's a calculation there and so forth. So next slide.
So this really was just to let you know what we're doing at Janover. We actually have helped a lot of people in the preparation of their application to get the money. We've been monitoring the use of the money. We reach out to our clients. We tell them to give us copies of their deposit and uses of money, the payroll. And we created a spreadsheet, a very complex model spreadsheet that makes the calculations of what funds are allowable, funds are forgivable, and the reductions, the safe harbor, all of the calculations we've talked about today. We've been working on this, and we intend to help our clients in the last stage of this, which is for the application itself for forgiveness. I'm sure many of our clients will need assistance. So just to let you know what we're doing at Janover, should you need us.
Yep. Yeah. And let's see, I'm just going to quickly look at some questions that I see posted. Let's just see. It seems like there was questions if you have a business and it's rented, the owner owns the real estate. What rent can you pay? Obviously, you have to have a lease agreement in place as of February 15th. If you don't have a leasing agreement enforced as of February 15th, then it's not going to be eligible rent expense. But if you have a lease in place, it looks like you can. Now, the issue is if it's a related party and you prepay rent, or you pay too high of a rent cost, or you pay just a ridiculous amount of rent, will it be eligible? There's no answer to that, but I suspect that the good guidance is I'm saying to people, don't be abusive, work within the rules, because I would hate to jeopardize your loan forgiveness piece and have the SBA come back or the bank come back and say, we don't think you're eligible at all. So there's a piece of it to manage aggressively and a piece of it to manage it within the contents of the spirit of the law.
Yeah, I agree with all of that. And I would also say that you might be concerned about that $15,385 cap, which we call cash compensation. You say, well, if I'm paying it and now that puts me over the $15,385, is that going to be a problem? Because you might consider that to be compensation. Well, I think our answer would most likely say that cash compensation is clearly defined in this program, saying that it is for salaries, it's for wages, it's for bonuses and commissions, it's for hazard pay, things like that. But it does not mention any payments for rent. So I think you would be safe that it's not considered compensation to give you a problem on the $15,385 ceiling.
Yep. Yep. Okay. Um, Marty, do you want to jump in and conclude?
Yes. Well, thank you very much, Barry and Joe. That was a truly illuminating webinar. There was a lot of information to absorb, and we had an awful lot of questions. I'm going to ask just one question because it seems very basic. What if someone receives their PPP money and their business is closed and they can't operate? Do they need to pay the salaries during the time frame? How would that work?
Well, actually, that's a good question. And we have a lot of clients in the retail businesses that their retail businesses close, or even in the restaurants or hospitalities. So if you borrowed based on the 2019 compensation 2.5 times, and let's say you got $250,000 of PPP money, if you are not paying any of the payroll because your office, your store is closed, then you're not going to get any forgiveness. So the purpose and the spirit of this is to bring back your employees, bring back your businesses. Congress, when they passed these rules back in March, at the end of March, didn't know how long this is going to happen, how long this pandemic was going to continue. So you may end up having zero forgiveness because you don't have any payroll during the covered period, or you may have a big dollar amount. And I think Congress is understands it, so they may lengthen this from 8 weeks to 12 weeks. But at this point, that's in the future. We don't know these rules. So the answer is it seems like it makes sense to pay people to get money forgiven, but you're paying your employer's share of the FICA tax to do it. So there's a value associated with it, and you have to make a business decision as to whether or not you want to do that or not.
There were a couple of bills that came up before Congress. So not only was the idea of lengthening that 8-week period to either 12, or in some cases they even suggested greater length, like 16 and 24 weeks, which would be wonderful. But there was also there were also a couple of provisions that maybe they would eliminate that 75%, so that you wouldn't need to have 75% of the money used on payroll costs. And that might get you some forgiveness if you didn't have payroll, because you would still probably be paying some rent and utilities, and perhaps you were paying a mortgage. You know, that's possible. But again, this has not passed yet. We don't know what form it would take. It's likely that there will be some change to what the rules are now, only because these questions are just like the one you just read. These kind of questions are what a lot of people are asking, because a lot of people have been devastated by having to close their businesses. So, you know, the people are looking for answers, and they have a lot of people in their corner trying to make sure that they come out of this okay.
Okay, thank you very much, gentlemen. To the extent that you have additional questions, please feel free to email Joe and Barry. And also, let me just say that a replay of the webinar will be available at some time. Okay, thank you very much.